20 years, graduate of FSU Business, and has a lovely wife and 3 grown children. I'm jealous, grown children.
Well, I assure you, it comes with its problems too.
And we cannot forget the baby of the family, the dog, the lab. So we hope that you find this informative, and of course, if you have any questions, we'll be here afterwards to answer them. I hope you enjoyed it.
All right. Please open your packets. There's something very special I want you to see before we get started tonight. This is going to be an interactive presentation. Pull out the $100 bill, if you don't mind. If you'll notice, it's not a spendable $100 bill, so if I get put in jail because you tried to spend it, Guido, the guy who gave me these, I'm going to have him come knock on your door, okay? So don't try to spend this. As a matter of fact, what we're going to do right here is part of the interaction. I want you to, if you don't mind, let's think about things that we need to be concerned about in retirement. So this is an interactive thing. So what are some concerns that maybe you have about retirement?
Money lasting long enough.
Money lasting long enough? Absolutely. That can be a concern. What may, I guess, let me rephrase that a little bit. What may eat away at your retirement? So this $100 bill represents everything that you've saved for, everything that you have sacrificed for, everything that you have built over your working lifetime, 35 plus years maybe, that you've built so that you can now retire. So what are some things that might cut into or possibly eat away at what you've worked your entire life for?
Health costs?
Health costs? Absolutely. That's a huge one. As a matter of fact, healthcare is rising 3 times the amount of inflation. So go ahead, let me see your $100 bill. All right, go ahead and rip that out and throw it on the ground. That's part of your retirement that you got to be careful of. All right, what's another thing that you really need to be concerned with in retirement? Inflation, absolutely. Inflation is another thing. So go ahead, be careful. Don't take too big of a strip.
Oh.
All right, what's something else?
Taxes?
Taxes. We're here. Taxes in retirement. Absolutely. So let's talk about taxes in retirement for a second. So what are some things that are taxed in retirement that we need to be careful of and understand? In retirement in specific.
You mean like Social Security?
Social Security is getting taxed, right? What else? What else?
Well, you deferred money from working.
Retirement plans. Retirement plans are getting taxed. Anything else?
Investment income.
Investment income, absolutely. If you have investments outside of your retirement plans, that's getting taxed. Anything else? How about poor market performance? Does that eat into your retirement? That there's losses. So go ahead and pull that out. What about kids? How about the kids coming back home and saying, "Hey, listen, I want what's mine now." How about that? So here you go. We started out with a full $100 bill, and look what I have left. So tonight, what I'm here to do is try to shed some light on things that you need to be aware of so that we can try to piece this back together again so we can at least do what we can to bring as much of that $100 bill back again, okay? Let's get started. So first of all, this is educational. This is not pure advice, and so that's part of what that disclaimer is about, is that we are here to give education this evening. Now, part of the entire presentation and everything that we're doing, there will be an opportunity for some personalized advice, and we'll get into that later. So let's get into the basics of the federal tax system. So about 50% of federal income tax filers pay 97% of all the taxes in the United States. So half of the people in the United States pay 100%, let's call it, of the taxes. And if you are fortunate enough to be in the top 10%, which is about 70%, paid 70% of the total taxes. And who is the top 10%? Well, an income simple as $138,000 puts you in the top 10% of income tax earners in the United States. Feel free if you have a question while we're going through this to ask. So there's been some major tax legislation just in the last 11 years. This was actually put together, this presentation was put together about a year ago. So it was when the tax law changed. And so it's now been 11 years, and here's some significant tax acts that have been put into place since 2008. So really the theme here is taxes are always really changing. And then the next slide, this covers some of what the last tax changes represent. First of all, most of the business tax changes that were put in place are considered permanent. The individual tax changes are actually supposed to expire in the year after the year 2025. However, one thing I would like to back up, and so if you think tax changes are ever permanent, take a look at what's happened in the last 11 years. There will always be a changing tax landscape, and you have to make sure that you're aware of what those changes represent, even if it does say that the tax changes are permanent. In Washington, I think we can all agree nothing is really permanent. So tax rates, what has changed? Well, marginal tax rates, long-term capital gains, and qualified dividends, we're going to go into that a little bit. Alternative minimum tax has actually had a significant change, and the kiddie tax has really had a small change in relationship to some of the other things. Marginal tax rates, you can see that there have been some slightly downward, all the green bars represent the new tax rates versus the, I guess I would call that burnt orange, represents the old tax rate. So there's been some changes. And by the way, all of this can be found in your book as well. So if you feel like you're not capturing something during the presentation, it's okay, it's actually in your book. So to put it more a visual perspective on the tax changes that have happened, the green represents, and this is for single filers, the green represents the new tax changes, and the orange still represents the old tax changes. So as you can see, for single tax filers from 200,000 to a little over 400,000, their taxes actually increased with the new tax law. Under the marginal, you'll see further in the presentation, there's some other things that are going on, but on the surface, for single tax filers making over $200,000, taxes actually at the marginal rates have actually increased. Married filing jointly, let's try that again. Married filing jointly, there we go, has really pretty much across the board, rates are actually lower for married filing jointly filers, except for these people. Whoever falls into this box right here are the few people in the world who actually their tax rates increased. But for the most part, married filing jointly folks do see a marginal tax decrease. Rates for long-term capital gains and qualified dividends, those have actually gone down. Let's see here. So it shows you for single people, there are three thresholds. So for singles, up to $38,600 are actually without, have no tax. After that, they're taxed at between $38,000 and $425,000. They're taxed at 15%. That's pretty much more in line with what we've seen in past years before the tax law changes. And also, for those making over $425,000 a year, the capital gains tax rate has gone up to, is up at 20%. And those are fairly standard of what's been going on even before the tax law change. Married filing jointly, as you can see, those changes for $77,000, there's zero taxes. You have from 77,000 to almost 500,000. You see that that rate is 15% and so on. Any questions so far?
So in your book here,
Yes, ma'am.
the charts don't quite match.
Oh, really?
Um,
Let's see.
So I guess that's because the new tax law, it's just off a little bit.
Well, I need to tell the people who print the book if that's the case. Let me take a look.
What page are you? I'm on page 10. Am I on the right thing?
I see what you're saying,
Oh,
yes.
no, wait a second, am I under, yeah, I'm under the right category, right?
Let's see here. Taxable income thresholds, 488. Yes, I do see some differences there.
It's
I will
just-
have to
it's
look
just
into
minor,
that.
but it's.
Yeah, no, absolutely, that's a good catch. I will certainly look into that. Thanks for catching that.
No, I just thought that maybe I was looking at the wrong.
No, you've got it exactly right as far as I'm concerned. That's a good catch. One difference between the old law and the new law that can be significant for some people is that now the tax law depends on the taxable income versus what your marginal tax bracket is. So it really focuses on the income, not the bracket. So they're using a different benchmark now. On the alternative minimum tax, anyone ever had to pay AMT before? I'm gonna skip through this a little bit because it is, I've never heard anyone explain AMT very well. It's a very complicated, way of having to file your taxes. The significant thing, if we can just move ahead past AMT right now, is the fact that almost 5 million people had to pay in AMT, and now under the new tax law, only about 200,000 people across the country are gonna have to pay an AMT. Two more factors to consider with taxes. So the 3.8% net investment income tax, that really hasn't changed, that's still in place. The one difference with the kiddie tax, anybody familiar with the kiddie tax? The idea is that parents would displace some income and give it to the kids so that they could frankly shelter taxes. And so that they put a kiddie tax in place so that the kids couldn't get away with, or frankly the parents couldn't get away with the kids getting less taxable income. So now, interestingly enough, and you can see, this isn't really a political statement, but you can see where both sides of the aisle, when they change this tax law, both sides of the aisle are wanting, something to change. And this is one of the areas now. Trust in the state income tax brackets follow the kiddie tax rules, which are actually higher than personal income tax brackets. Three takeaways with really the taxes. Marginal tax rates are generally lower across the board. Pretty much the status quo when it comes to capital gains and net investment income tax. We also have the AMT is still a factor, but it's greatly been diminished. Anybody familiar with itemized deductions? Itemized deductions have been a part of the U.S. tax code for many, many years. It was how people really tried to lower their tax bill. Those have pretty much gone away now under the new tax law. They've been greatly diminished, at least. However, what has also changed is the standard deduction has greatly increased. So the idea with the new tax law is like, listen, rather than you trying to figure out how to lower your taxes through all these deductions that you may have, why don't we just go ahead and give you a higher standard deduction right up front instead of you having to do all those you know, trying to find extra things in your life that could probably equal a deduction, let's just go ahead and give it to you right up front. They have done away with the personal exemption. So once upon a time, well, before the tax law change, $4,050, you had a personal exemption for each member of the family. They've done away with that. So here in this example, you'll see where a married couple in 2017, they did away with the personal exemptions. And then what they did in turn was they pretty much doubled the standard deduction. For a family of 5, this is an interesting difference. You will see a family of 5 has actually their deductions and personal exemptions have decreased because this is gone. This line item's gone. They bumped this line item up, but they've completely done away with the personal exemptions. However, remember this slide because it comes back in the way of child tax credits here later. And frankly, who here has minor children that they need to worry about? Well, besides Jennifer. So taxes in retirement, there's not that many people that have to worry about finding child tax credits when it comes to taxes in retirement, except one of my neighbors. So itemized deductions, the good news, they actually have lowered the threshold for qualified medical and dental expenses. So that's good, just to help defray the cost of medical expenses, as we mentioned earlier, are going up and up. But notice it actually does come back in actually after this year or during this year. Higher deductibility cap for charitable contributions as well. So here's the not so good news about itemized deductions. So they've done away with casualty, theft, and loss deductions, as well as miscellaneous itemized deductions. We kind of talked about that. Those miscellaneous deductions that you used to look for, they've kind of done away with those now because they raised the standard deduction rather than you try to find all these miscellaneous deductions across the board. Home mortgage interest. I saw your realtor tag earlier, so you probably already know this. Might even be able to teach us a thing or two. But home mortgage interest, there have been some changes in that. Before the new tax law, up to $1 million in acquisition debt, and now that has dropped. Now that has been grandfathered in. If you had that acquisition debt before the new tax law, you're grandfathered in. One thing that has changed is also when it comes to home equity lines of credit or home equity loans, those are no longer deductible except if you use that for an acquisition cost. So let's say you have a home free and clear or almost paid off, you're able to use a line of credit or a home equity loan for a second home. You can actually deduct the interest on that. Now, if you decide to use a line of credit or a home equity loan to sail around the world, that's not going to qualify for a deduction. Make sense? If you use it for acquisition costs for your home, though, that could be a big difference.
And it can be within your current home, so if you were remodeling.
Correct. Significant changes or upgrades, that's correct. Of course, here's where the disclaimer comes in, consult your tax advisor, right? So, home mortgage interest, once again, the HELOC proceeds used to buy, build, substantially improve a qualifying residence. That does qualify as acquisition debt. I'm going to skip over state and local taxes because fortunately, one of the reasons why people move to Florida is state and local income taxes are not something that we really have to talk a lot about. Thank goodness. However, a couple things I will point out in that for those who are in state income tax states. Because of these tax law changes, the states, you know, they were able to say, hey, listen, you're gonna get some sort of deduction on your tax bill on the federal level because we're charging you state income taxes. One of the challenges with the new law is that they actually did away with that deductibility, and now you have a lot of states who charge state income taxes. They're not very happy about that, and there's probably gonna be a lot of litigation involved with that. Okay, so basically, standard deduction versus itemized deduction, just to kind of recap a little bit. So the amounts nearly double on the standard deduction, and also the limits on home mortgage interest deduction and state and local tax deduction, those have gone away. Here's the child tax credit. So here's where some of that family of five actually starts to get more tax relief. Child tax credit has actually doubled. Maximum refundable credit. Anyone know what a refundable versus non-refundable credit is? A refundable credit is a credit that is worthy of you getting a check sent back to you from the federal government if that's the difference in your taxes. A non-refundable credit means if this is the difference between you receiving a check and not receiving a check, you're not going to get a refund if this is the difference maker. Does that make sense? So if when you do your tax calculation and you file your taxes and you're on the borderline, man, I don't know if I'm gonna have to pay or if I'm gonna get a refund, if you use this credit, the non-refundable credit, that means that if it's the difference between you receiving a refund or having to pay, it's not going to be able to send you money back. That's the difference between a refundable credit versus a non-refundable credit. Does that make sense? Okay, so let me see here.
But it's only if you were able to take advantage of the child.
That's right, that's right.
Okay.
It's only if, actually available for dependents who are not qualifying children under the age of 17. So let's say if you had an adult living with you who was a dependent, you could actually get a $500 credit, but you would not get money sent back to you in a refund if that was the difference maker. So let's say you were gonna have to pay $200 this year after you did your taxes. And then what you'd be able to do is if this was the difference maker, you'd actually zero out, but you'd lose $200 worth of credit, or I'm sorry, $300 worth of credit, because they're not gonna give you more money in the way of a refund. They're gonna zero you out, but they won't give you the full credit. Does that make sense? Okay. That's a little difficult to explain sometimes. Here's that family of five again. And so here's where you can see in 2017, they had the personal exemptions, so $4,050 each with the family of five. So they were able to use that $20,000 exemption. Then with the tax law changes, they have the child tax credit, which kicks back in. As you can see, the $3,000 credit equivalent to a $13,636 deduction actually brings that total up to $37,000. Does that make sense? No? Okay. All right. So the difference between a deduction and a credit is a dollar for dollar. You get $3,000 of credit. A deduction means that you get a percentage versus the whole ball of wax. And so because you're getting the credits, that's the difference maker and actually gives you a higher deduction overall because you're getting those extra child tax credits. The next difference, Roth IRA IRA conversions, you know, something that we do in our office quite a bit, working with clients, is you know, trying to get future tax money and turning that into never tax money. But one of the challenges that one of the games, frankly, that would be played sometimes before the new tax law is if you had market losses or investment losses, you could actually what's called recharacterize the Roth. If you switched it from a traditional IRA to a Roth IRA, and then you had investment losses, you could actually go back so that you could take advantage of those losses. But they did away with that. So once you convert to a Roth IRA now, you can't go back. So whether you know, income or investment losses or not, once you convert to a Roth IRA, you have to stay there now.
Do you know if they ever came out with like a break-even point between the old and the new? Because now when you convert, in theory, you would be paying less taxes. So some people have been advertising that you might want to convert before the tax law changes in 2025. I was not aware of that other piece that you said, that if you had losses, that you could then
Right,
take
right.
advantage of that.
But
So-
yes, so you bring up a great point. Let me see if I can for everyone. Did y'all hear what her question was? Okay, so the question was, does she want to now, because there's been a overall tax deduction? Matter of fact, especially for married filing jointly, all right? So across the board, we're having to pay basically lower taxes than we were before the law. Orange is before the law, green is after the law. So basically only these people now with the new law would be paying higher taxes. And so, yes, so I would agree, generally speaking, agree that Roth conversions now are actually a great opportunity because the tax law changes may happen in the future in 2026. That's correct. That answered your question? Okay. Another change that has happened, the enhancement of 529 savings plans, you can now use them for K through 12 tuition expenses. Once upon a time, you could only use them for higher education expenses, and now they're allowing you to use those funds for public, private, and religious secondary schools or elementary schools. That is certainly a tax law change. Once again, probably not a tax law change that most people close or in retirement are affected often by, but it is a tax law change nonetheless. Annual withdrawals up to $10,000 per student for the K through 12. And also rollovers and transfers to ABLE accounts. ABLE accounts, you don't hear a whole lot about those, but it actually can be a great planning technique and planning tool for those with disabled children. It is a special account available for those with disabled kids that can grow. It works just like a regular 529 plan for higher education expenses, but it can be used for qualified expenses used to pay, help that disabled child. And once again, one of those tax advisor, whatever counts as qualified, but certainly things that would help a disabled child, even as an adult. You put the money in the account, you let it grow, and then that can be used later in life as tax-free. So that's a neat little. You don't hear much about ABLE plans though. Other changes worth noting. Anyone have to worry about alimony around here? No? All right. But anyway, so alimony is no longer deductible by the paying spouse, and also not included in the recipient's income, implemented after December 31st, 2018. A couple other Affordable Care Act, they have repealed the responsibility payment or the fine for those who didn't want to sign up for the Affordable Care Act policies. You, once upon a time, were fined for that if you didn't sign up. They repealed that. Also, moving expense deduction for a job-related move, except for, that's been removed except for members of the armed services. Provisions affecting business owners. Do we have any business owners in here? Sort of a business owner, a realtor? Absolutely. You run your own show. 21% flat corporate tax rate. Also, pass-through business income deduction. So now small businesses, pass-through business income really is focused on entities that end up for small businesses, S-corps, LLCs, that sort of thing. It's a pass-through that ultimately ends up in the owner's pocket, but they're getting more and more deductions now than they were before the law. A couple of things that are affecting, I would say, on a negative scale is that you are not allowed, it's starting to scale back bonus depreciation. So you've probably all heard, hey, listen, you made too much money this year, go buy you a new car or pickup truck or whatever the case may be so that you can get that bonus depreciation. They're phasing that out over time. So where do you go from here? So you talk to a qualified tax professional. We would love to help you work on that situation. We actually have a tax software program based on your tax filing. We can show how efficient or inefficient your taxes in retirement are. So we can go in, take those numbers, put them into the software, and then it produces what's called a tax map on ways that you could become more efficient using your retirement dollars. One of the challenges you have in retirement is that you have income from different sources that could potentially be taxed differently. So being able to use that tax map to better understand, well, if we take dollars from this bucket of retirement, we might be able to, be a little more tax efficient. And just being able to see that and understand that can really go a long way. But more importantly, out here, and the name of the presentation is Taxes in Retirement. Who enjoys taxes and, frankly, the subject matter of taxes? Nobody, right? And I would also argue that taxes in retirement is a consideration in retirement, but I don't think it's critical. I think there's also some critical things that people getting close to retirement need to understand and know. And if it's all right with y'all, I'd like to spend about 10, 15 minutes on things that I think are even more important than taxes. Is that all right? Great. So let's go over. So first of all, we talked about inflation when we tore up our bill earlier, right? So the idea of inflation is that as prices go up, your purchasing power goes down over time. And so, once in today, something, $50,000 of income, in 25 years, you're gonna need twice the amount of income to pay for goods and services as you did before you started. So you need to make sure that you are aware of that you are taking advantage of that, and that you have something in your retirement portfolio that is outpacing inflation. If inflation is going up 3%, you need to make sure that you have something going on in your life that's earning overall more than 3%. Accounting for healthcare costs. Jennifer Shimp, our lovely assistant here this evening, she's actually a Medicare specialist. She helps people find the best course of action for their Medicare dollars. And that is definitely, as we discussed earlier, healthcare expenses in retirement are going up 3 times as high as inflation. So certainly healthcare is a concern, and making sure that those dollars are being used as wisely as possible to keep as much as that dollar bill together as possible. long-term care. Accounting for the cost of long-term care is a huge issue. Let me tell you what I did Sunday. Sunday, I had to go to a memorial service. Unfortunately, it was one of my long-term clients and friends, and she was and really she wasn't wealthy by any stretch of the imagination. And so of course, part of my job as an advisor is to make sure she never runs out of money. And she had failing health. And had she had to go into a long-term care facility, her assets would have drained dramatically quickly. It was fortunate, it was a blessing, frankly, that she never needed to use the long-term care. It would have absolutely devastated her financially had she needed it. Fortunately, she was able to, because she didn't need the long-term care, she actually had a situation medically that she never, frankly, could never get that far to get into a long-term care facility before her body gave up. But fortunately, her wishes were always that she wanted to have a portion of her assets go to the church and a portion of her assets to go to her nephews. And so she was able to, through our work together and what we did, we were able to pass that along. Had she been in a long-term care facility, that never would have been able to happen. So certainly something that people in retirement need to understand and know, and we'll dive into that actually a little bit even deeper here in a second. Personal savings and allocation is a huge piece. You know, we talked about investment losses and how that can eat into your retirement. Making sure that you have a well thought out plan that is beating inflation over time, but yet is also conservative enough that you don't take big investment losses. That is something that all retirees need to know and understand, that they need to have a plan in place that has a element of conservative nature so that you're not having big investment losses, but also that you are growing your assets to beat inflation and frankly healthcare costs over time. That's a tough struggle. You can't do both. You have to balance that out with a asset allocated plan so that you do have some safety, but you also have some growth. Sequence of returns is another big one. Can y'all see those numbers or not? So sequence of returns means that you need to make sure over the short term that you have, once again, asset allocated plans in place, because what we have here, let me explain it to you. We have a chart on the right, and this is the S&P 500 from 1989 to 2008. You start out with $1 million, and you take $50,000 a year out, and you take out a 3% inflation piece, so that over time you're taking out a little bit more, so that you're basically paying for the cost of goods and services as they inflate. Now, from 1989 to 2008, we started out with $1 million, and by the end of 2008, even after a 37% loss, we had over $3 million. If you were to reverse the from 2008 and go backwards, you actually run out of money 2 years prior than the other direction. So sequence of returns is basically something that should shed light on what you need to do. Now this is the S&P 500, so this is all stocks. Certainly part of what we already discussed is having an asset allocated plan to make sure that you understand the sequence of returns and how devastating it can be to a portfolio if you're not putting assets in different buckets, basically.
Those are actual numbers?
Those are actual numbers, yeah. So I remember 2008,
Yeah, we had a big.
37% down, and remember the 90s, how great the 90s were in the stock market? So these are the actual numbers, the S&P 500. Interestingly enough, Because it's the same numbers, you still have the same average return. But because when things happen, you started out with $1 million.
Yeah, losing 37%.
And you lost 37% right off the bat. And the problem is now that you're withdrawing money, you can't, it makes it harder and harder to recover. As a matter of fact, here we have the chart right here. So if you have a 10% portfolio loss, you need to gain 11.1% to get it back to where it was. A 20% loss, you need to gain 25% to get it back to where it was. And this is the probability of getting it back to where it was over that number of course of years. So if we lost 20%, we need to gain 25% to get back to where we were. And over 3 or 4 years, 70% chance of success to do that. That make sense? So naturally, as you see, the heavier losses you take, the harder it is to get back to where you were. So to recap a couple things, when do you plan to retire? I mean, these are all questions that you need to ask yourself, and frankly, you need to spend time on. That you understand, so how long of a period do you plan for? I mean, no one really plans on, I'm going to dial in 10 years and call it a day. I had an uncle and my stepfather. They both, they felt like they did not have a long time. They were right in retirement, unfortunately. But the thing is we are all living longer. How much income can you expect from Social Security or an employer pension? Anyone here have Exxon retiree? Do you still have a pension? Awesome. You're one of the. You're like a unicorn.
No, there's a lot of people in our age bracket.
Well, that's those are a quickly dying breed. And have you reviewed your tax efficiency? Also, have you considered the things that we just discussed? Inflation protection, healthcare costs, long-term care plans, and allocating your portfolio to handle the ups and downs of a market. So here's where the second part of our presentation comes in. You, as part of this presentation, this was educational tonight. You have the opportunity to get advice at no charge, obligation, or anything like that. And so I'm offering the extension to you to take advantage of spending an hour with me, and so that we can go over what your retirement situation is. We can review any questions that you might have. We can do a tax efficiency analysis for you. It would be your hour. What's going to happen? We're just going to you're going to tell me what you need to hear, and I'm going to ask questions so that I can try to give you tools for success for your retirement. What will I learn? Well, it depends on what you ask. I really want to make sure I understand what your concerns are and provide you guidance and expertise on, what you were looking for. How long will it take? Like I said, it'd be about an hour. Make it well worth your time. Will I try to sell you anything? No, that's not me. We just want to make sure that, frankly, hopefully develop a relationship. But at the very least, what I want to do is make sure that you are, that you get the tools that you need to get the answers that you need for your retirement. Where will we meet? Well, that's really up to you. I don't mind meeting anywhere you like for an initial meeting. If we ended up working together over time, I would ask that eventually we would need to meet at my office. But but a coffee shop or your home, or if you want to come to my office, I prefer my office because I have all the tools at my disposal at my office. But certainly wherever you feel comfortable for us to meet. And what would be the next steps? Well, there's really 3 options there. One, after our meeting, you decide that we want to work deeper together and start working towards some goals and some finer plans on how we would work together. or two, you know what, maybe now would not be the right time to work together, but we would share information and stay in contact and see when that time was right. Or three, we'd decide that we hated each other, we never wanted to see each other again, and we'd run away as fast as possible. So those are one of the three choices. And so typically what happens at an appointment, as far as, I don't have my calendar, I actually have my calendar here. We can go over that tonight if you want to go ahead and make an appointment. And by the way, that is also in your booklet. I want to think about all this. I would say that you should think about all this because this is a lot of heavy stuff. And frankly, I want to work with people who are thinking about this and don't take this lightly. Or maybe you have already another advisor. If you have another advisor, I would challenge you a little bit. You came here tonight for some reason. We are retirement distribution specialists. I have peers in town who focus on other areas in the financial world, but that really is our bread and butter. What we do for a living is help individuals and families that are in retirement and how to, they spend a life getting up the mountain of Mount Everest. Now let's work on what's the safest way to get down Mount Everest. These numbers, just to share a couple things with you. So over the next 15 years, we are in the midst of something that this world has never seen before. Over 70 million people in the United States will be retiring over the next 15 years. It's never been done before. There is the largest amount of wealth transferring to a retirement idea. And by the way, there's never been a concept of retirement up until about 40, 50 years ago. There was no such thing. As a matter of fact, at 1934, that's when the Social Security Act was put in place. The 65 and 62, 65 was the age that was put in place by FDR so that you could get your full retirement benefit from Social Security. The life expectancy back then, when that was put in place, was 62. Social Security is currently working on a system that was built to work to the government's benefit, not your benefit. However, when we see Monaco, Japan, and Singapore up there, those numbers right underneath those three countries, those are currently the life expectancy of each one of those countries. 89.4 in Monaco, 85.3 in Japan, and 85.2 in Singapore. The United States currently is at 79. So needless to say, we are experiencing something that has never happened in the history of the earth. Retirement in the United States.
Oh, we can move to Monaco.
Oh, you can move, yeah, that's right. Just ask for the 89-year guarantee. Listen and find out what
Must be the food or something.
Yeah, right, exactly.
It's all that wine. I was just gonna say.
Probably right.
But, so part of our dollar bill exercise earlier and ripping that up is that I want for you to leave this evening feeling empowered. That is something, because retirement can be overwhelming and it can freeze a lot of people into a lack of discipline and a lack of action. But it is something that can be taken on. Matter of fact, about 20 years ago, I actually put this Norman Rockwell, I actually had it framed, and I put that in my office 20 years ago, and I thought, this painting best represented what I believe my clients, of course 20 years ago I was a lot younger and a lot further away from retirement, but when I bought this painting, that's what I always envisioned how people entering into retirement felt like, and that I needed to help that guy get down from the diving board the best I could. Thank you this evening. Appreciate your time and look forward to seeing you here soon.
Okay, so you had mentioned earlier about, as far as your next steps, that one of the things that I guess you would hope to do is build a relationship with someone. So are you
Great question. What about, yeah, so ultimately, how do I earn my living? How's that? Is that a good way to put it?
Somewhat, that was part of it.
Okay. So I am a independent advisor. I have, frankly, the widest array of opportunities to work with people. As far as I'm concerned, I have tons of peers who wish they had the ability and the flexibility to work with people the way I do. I can work with people on a fee-only, flat fee basis, if that's the way they want to work. I can work with people through implementation of assets under management, if you're familiar with that type of style. I can work with people also through, I'm fully licensed for annuity production and all that kind of fun stuff. So it really depends on the individuals that I'm working with as to how I work with them. It is something that through that conversation and relationship, we mutually agree on before moving forward. Because there's some people who come to the table and say, hey, Billy, whatever we talk about here, whatever we do, I don't ever want to see annuity in front of me. And I have other people who sit in front of me and work with me, say, Billy, whatever we do, I don't ever want to lose a dime of this money. And so I put plans in place to work with both those types of people.
Do you offer a one-time fee for tax consulting?
So I would say that would probably be something I would rather talk about on an individual basis, because frankly, you know, depending on what you're looking for, you may be better off with a CPA. But I would want to have a better understanding of what we were looking at to give you the most honest answer. Sure. Any other questions? Well, thank y'all. You know, my goal was to make sure that you made it home before the sun went down, and I think we will have done it.
Because I have a long way to go.
Oh, do you really? Where do you have to go?
Well,
Oh, okay, all right.
I guess because they have to do it for their tax.
I believe I have met you at a realtor event or something before. You look very familiar.
well, I've been in real estate a long time. I've been in real estate here for 16 years.
Okay. Are you involved with the chamber at all here locally, or any type of group events?
Rotary, so I'm involved in.
Oh, yeah. What chapter?
St.
Or which
Augustine,
club?
St. Augustine Sunrise.
Okay, all right. I'm
and
trying to
then
think.
River House.
Does, is that, what's her name?
Carolyn
Tammy, her Morton now. Used to be Tammy Shoup. Now it's Tammy Morton. Anyway, she's in one of the Rotary clubs down there. I thought it was Sunrise, but, anyway, we're
That's
friends.
not me.
Gotcha.
I'm involved in some of the, I'm involved in the education committee and the board of Realtors.
Okay.
And,
I know I've seen you before.
okay. Well, I appreciate your advice and your information.
Well, very good.
I tried to talk my husband into coming.
Oh, is that right? Well, very good. We'll, hopefully talk again soon.
Okay.
There was an evaluation form there. I don't know if you had a chance to fill that out or
No,
not.
but I will.
Okay, great.
Let me get over here.
I'm cold.
I miss cold.
I don't know how to do this.
Well, I'll sleep with, I will be, wearing a jacket, believe me, on Thursday.
We're just gonna take one folder home.
Okay, all right. Very good. Yes, sir. Dominic, yes, sir. Okay. Okay. He's had a good run.
Take some cookies.
Well, so
They're just gonna throw them.
annuities
You can't bring them to, the fire department?
Sure.
You know, I'll see what I can do.
There's,
Thanks for
oh, and, you pass the fire department, I know they take the, in our neighborhood, we have leftover stuff.
It was nice to meet you.
Same here, okay, let's see, we have forms of.
Thank you.
Thank you
Have a
very
good day.
much.
Here you go. Thank you. You have a great night.
Nice to meet you all.
Likewise, I like your earrings, those are very pretty.
Oh, thank you, thank you.
Mhm.
It was lovely.
That's right, right, right. That's right, that's right.
So we're trying to make it work. So, my question to you is, if anything, we would like to set the thing
Okay.
more than actually,
Absolutely.
so I know if you would agree with us, but based on just that intent, just for the second
Sure.
opinion, I'm not saying that we want to.
I understand you.
Because
I would
he's been on the vice now for 11 years.
be more than happy for a second opinion, and frankly, that's part of what I give second opinions all the time. Some people say, hey, listen, I think I like what direction we're going, and some people say, thanks for the information.
The only thing that he has signed up with since 2008 is life insurance.
Okay?
Both of life insurance policies are just more than one. And it's that kind of life insurance that accumulates money over
Yeah.
time.
Cash value life.
Cash value, exactly.
Permanent life
And then you
insurance.
could take that, when you retire, whatever, you could draw money at that. So that's another big part of it.
Okay.
Just to give you an idea,
Yeah,
more or less what we're
right.
saying, you know.
Good.
But,
Very rarely do people put those in place and actually run them through retirement, so congratulations.
because what, take them out? They can afford to
At the
pay.
at the moment, I need money somewhere
Yes,
else.
so do we.
Right, so.
So do we.
Yeah, right.
And we are trying
Yeah.
really, really hard
Yeah.
not to do that.
Right.
Really. Because we got to the place right now where after 11 years, 10 years, 11 years, now it's when it's actually starting making more money as the years go by. The first 6, 7 years it wasn't making anything at all. Now, he told us, he said,
And that's
now
why-
it's hard not to take the money, because don't take the money out now, because now it's when.
Now it's growing.
Now it's growing.
Right. Yeah, that's the challenge with
I
probably a whole
don't
life
know.
policy, the way it sounds.
Yes, that's exactly what it is. Hold on.
Okay.
Now, I don't know until what age we're gonna be able to still pay this
Right.
amount.
Right.
You know, it's gotta stop somewhere. So again.
They can do what's called an in-force illustration, just to give you an idea, maybe you've had that done before.
Yes.
He's done a whole bunch of things with us, again, it's been, I don't wanna say that I wanna drop it just because we moved down here.
Yeah,
We're
right.
still, we're still in contact, we're still handling our retirement.
Mhm.
But just to have a second opinion.
Yeah,
Just to
we,
see where.
we're more than happy to give you a second opinion. I know my card's in the folders. so,
Yes.
And of course, if you have an idea of when you would wanna meet, you can fill out one of those forms.
We filled that.
Great, I'm sorry, what was your name?
Patricia.
Patricia, my wife's name is Patricia,
Oh,
so
okay.
easy to remember.
Yes.
So, that's where we stand right now. And I understand, I understood most of the stuff you explained.
Okay.
But, I do try to keep up with.
Yeah,
this,
no,
uh,
are you working, are you
Right
actually
now.
retired down here? Okay.
Well, I retired early, but I'm still looking for work.
Okay.
So I'm still not over.
What kind of work do you do, or?
I used to be a letter carrier.
Okay, wow, all right.
But now I'm just trying to find employment,
Mhm. I got you.
supplemental, I guess you want to
Sure,
call it.
right. Well, that actually is a huge trend in retirement, is people doing basically supplemental, part-time, whatever term you wanna use,
Yeah.
but working some, but not busting their buns 24/7.
Yeah.
So.
Yeah, like I said, we haven't been able to put any money aside, except for the insurance.
Right.
The whole life insurance, we still pay that.
Mhm.
But as far as the other stuff, the 401k, the whatever else we have,
Mhm.
we'll never be able to contribute any more money to that, which is really,
Since we relocated,
Since
yeah, I
we-
just
Okay.
found some,
It's-
I'm
it's
looking,
here.
keep on the nurse.
Okay, gotcha.
So I'm working, but, I'm still, as I'm working, I'm looking.
I got you, yeah. Yeah, well, that's a great industry to be in anyway, especially in Florida. There's always employment available.
Yeah.
Now, whether or not you wanna work is a different story, but,
No, I do, I'm
You
very
love it?
active in
Good.
insurance.
Gotcha.
can
All right.
contribute, I wanna be active.
Well, good. I look forward to meeting with y'all. Do y'all live close by?
We're
Yeah,
in
right
St.
there.
Augustine.
Okay, all right.
We're about 7 minutes away. Grand Lake is right past
Okay.
Portobello.
Okay, yeah, all right, good. So
So-
hop, skip, and a jump. My office is, you literally pass my office to get here tonight, so.
There you go.
I'm in Little Golf Village.
So you wanted me at the office instead of home? So,
I don't know.
It's easier for me because if you had a question, I have a nice big screen TV that's plugged into the computer and we can look at tools and do
what
things.
would you need us to bring?
Nothing.
Nothing?
Nothing for the first appointment, just want to sit and talk, get a better understanding. You know, if you're concerned about these life insurance policies and any other type of savings programs that you have, bring those if you want me to look at them, but you don't feel like you have to bring anything. But if you want me to take a look at something, bring it.
All right.
Make sense?
Okay, yes.
Okay.
Okay.
Well, thank y'all so much.
Thank you, Dan.
Yeah, absolutely.
Again, it was
Thank you,
excellent
Patricia.
presentation.
Thank you, thank you.
The cookie finally got me. I've been sitting there all
Sorry-
evening
sorry
and
there weren't-
finally
there weren't more
happens.
people here.
Finally.
Well, you know, there was plenty that signed up, so.
I know.
I'm not sure why.
No.
This-
I think I understand
you said
traffic
it-
was terrible
You said
tonight.
it most appropriately that there's not enough people taking recycling seriously.
Yeah.
It really isn't.
No, they're not. I read,
I mean, I thought we
I
started
read all the
later, but we
articles.
should have
by the
started
time
last.
I can
I
tell.
do,
Right.
And
Well,
most of them, most
all of
them
us
say
could have
that
started a
lot of
little
people
sooner, no
here
doubt about that.
in the United States rely too much on Social Security,
Absolutely.
and they're gonna be shocked when the time comes.
Oh, yes, they already are.
So-
Cause I work a lot with Medicare people, so a lot of them are already.
Oh, yes, you see it, I know, I see the effects because in the hospital.
You see, true is about 50% of the population rely on Social Security, is that
and
Say
Social
that again?
Security On only, yes, only Social
50%? About 50%
rely only on Social
population
Security.
rely on
Yeah,
Social Security.
I would probably say it's probably even higher.
Even higher than that.
I would say it's higher.
All right,
Have a
guys,
good night.
thank you,
Thank you.
appreciate it.
Good
All
night.
right.
Right. Well, I'm wearing a jacket on Thursday.
Well, when I came in here today, it was ridiculous hot.
Before I forget,
Mm-hmm.
I have a suggestion for you.
Yeah, sure.